Today, we will take a deep dive into the world of value investing, the home of Charlie Munger, Warren Buffett, and Benjamin Graham. But why? And more importantly, how do they find value? And when do you know it's time to invest? It all starts with the most important principle, buying low. This is the key to investing. It can be seen as the starting point since it guarantees good value for what you pay. As Graham would say, when you buy stocks at very low levels, you increase your margin of safety. Just like buying groceries, health, beauty, or tech products, you start by doing research. Should I buy the iPhone 17 or the 17 Pro? Is 5.5 cents per fluid ounce a good price for a Coke 12 pack? Is it cheaper at Target or Walmart? You probably know the phrase, that's a great value for the price. That's exactly what value investing is all about. Finding bargains at reasonable prices and holding them for the long term. To find bargains, we need a comparison metric. The same way we compare Coke by price per fluid ounce, we need a metric for stocks. Investors usually look at the so-called price to earnings ratio, where the current stock price is divided by the company's earnings over the last 12 months. Take Procter & Gamble, for example, with the current stock price of $142.69. Over the last 12 months, the company earned $6.83 per share. Dividing these numbers gives a PE ratio of 20.89. In his book, The Intelligent Investor, Graham recommended a PE ratio of around 13.3 in an environment with 7.5% yields on 20-year AAA corporate bonds, as a rough rule of thumb. Since today's yields are around 5.26%, that would imply a PE ratio of about 19. Of course, this isn't a strict rule, since Charlie Munger would also consider the quality of a stock. Quality means cash flow stability, low volatility, market dominance. Procter & Gamble, for example, has increased dividends for 69 years, has a beta below 1, and owns strong brands such as Head & Shoulders and Tide. The PE ratio helps us compare stocks, both with others and with their own history. When a stock trades at a low PE compared to its historical average, a value investor knows it might be undervalued. Munger recommends incorporating quality by comparing the median PE of the last 3 to 5 years. For Procter & Gamble, this median is about 26, suggesting the stock may currently be undervalued. So what are the exact steps for choosing a value stock? First, do your research, understand the business model, and identify a long-term competitive advantage, also called a moat. Then set a target price or valuation, e.g. a PE ratio of 21 or a price of $140 for Procter & Gamble. Most of the time, value investors simply do nothing. As Buffett said, the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. Third, buy during market panic. When fear spreads, a value investor gets ready, like a hedgehog waking from winter sleep. But how can you identify the panic? Besides low PE ratio, it helps to look at the overall market sentiment. One useful indicator is the VIX, the volatility index, which measures market fluctuations. If the VIX spikes significantly, it may signal a period of fear. For example, during April's tariff panic, the VIX shot above 50, close to pandemic levels of 60 in 2020 and the financial crisis of around 70. Such extremes are rare and often mark opportunities for value investors, since buying in fear creates long-term rewards. Another useful signal is a spike in high-yield bond spreads, published by the Fed. If yields of these bonds rise sharply, it means risky companies struggle to sell debt, a sign that market fear is high. In the hierarchy of risk, stocks are typically riskier than corporate bonds, which in turn are riskier than treasury bonds. The gap between low volatility value stocks like dividend payers such as Procter & Gamble and high-yield bonds is often small. For example, companies like Carnival issue such high-yield bonds, offering only slight safer returns than risky equities. When these yields jump, it's a clue that risk aversion is increasing, potentially signaling market panic. A combination of stocks down 30% or more from their highs, plus spikes in the VIX and high-yield bond spreads, gives the value investor a tremendous edge. He focuses on bargains, not momentum. This margin of safety, as Graham called it, is exactly what enabled Berkshire Hathaway to buy Apple at a phenomenal PE ratio of 16. How did Buffett and Munger manage this? They learned from Graham that doing nothing is often the most important skill for an investor. Do your research, set a target price, and wait until the right moment. Not when the market trends skyward, but when everyone else is panicking. That's exactly what we did when we bought Apple in April 2025. When nearly every major outlet, from Wall Street Journal to Barron's, criticized the company for potential tariff issues and lacking AI features. Now we are up more than 40% since then. Be fearful when others are greedy, and greedy when others are fearful is one of the most simplest lessons. But applying it in practice is what makes value investing work. Thanks for watching and see you in the next one.